Hey everyone, welcome back to Upside Down Data. Today I want to talk about Bitcoin and whether or not its volatility is really decreasing over time in the way that a lot of people say. If you like the content, remember to subscribe to the channel, give the video a like and follow us on Twitter, put a lot of updates about indicators and more over there. So if you've been following Bitcoin and the Bitcoin market, one of the things you've probably heard before is the idea of diminishing volatility over time. And another way that people often put this is diminishing returns. It's this idea that as Bitcoin gets older, as its market cap grows larger, then moves to the upside every single market cycle will get smaller and smaller. And then people also argue that moves to the downside, so, falling off of the all-time highs, should also not fall down as far. The drawdowns should not be as painful as in previous market cycles. What I want to do, though, is look at this and ask the question, is diminishing volatility to the downside really the same as diminishing volatility to the upside? Or another way of putting that is the volatility to the downside diminishing at a similar rate that volatility to the upside has been diminishing? So I want to show a chart here. This is the weekly chart for Bitcoin across time. Now, this is a bit of a messy chart. I've got a lot going on here, but I'll just explain what I'm trying to get at with this. So what I have measured here is the moves to the upside and the moves to the downside. Now, with this first one, it's a little bit unclear exactly where to define it. I guess I'll just go from absolute wick to absolute wick. And so again, volatility to the upside, volatility to the downside. And really what I want to show first is, let's talk about volatility to the upside and how that's been diminishing over time. So with this very first one, if you measure this, and again, this wick is incredibly, questionable here, but I'm just going to go with it. So this would be, if we measure it that way, a 300,000% move to the upside here. In this second big bull market in 2011 to 2013, that would be a 62,300% move to the upside. In this move from 2015 up into 2017, that was a 12,000% move to the upside. And this most recent bull market from 2018 to November 21 was 2,100% move to the upsides. So there it's very obvious, right? You can just see it on the chart. Volatility to the upside in every single bull run, every single kind of big market cycle to the upside, the move up has been getting smaller and smaller over time, and that's quite obvious. But now let's look at the volatility to the downside and see if that tells us a bit of a different story. So for this first one, we see 93% drawdown from the absolute top to the absolute bottom, pretty brutal. The second one was an 86.5% move to the downside going into 2015. But then in 2017 to the bottom of 2018, that was an 84.5% move. And more recently, now we don't know if this is the bottom, so I'm not really putting too much significance on this, but so far we've max drawed down 73.8%. But really, when you look at these drawdowns to the downside, obviously the first one was the most severe, and that's notably so that's definitely bigger than the other ones. But when we compare the move in 2013 to 2015 to the one in 2017 into 2018, these are quite similar, right? 86.5, 84.5. Technically, that's diminished volatility. Technically that's a smaller drawdown, but that's not really all that meaningful, right? 2%, who cares? 2%, that's margin of error. You can basically treat those as being the same, that there's wasn't really much difference in the drawdown between those two times. And if that's the case, then we have to ask the question, all right, is it really correct to say then that volatility to the downside will necessarily be diminishing over time? Because so far, arguably, it hasn't really. I mean, technically, yes, but it's so close that, if you're thinking in a statistic way, a statistically significant difference, a 2% difference is hardly meaningful. That's something you can usually, you just kind of generally treat numbers that close to each other as being roughly the same. So I would argue that these two drawdowns were, for all intents and purposes, basically the same. And so that might draw into question this idea that volatility to the downside should necessarily be diminishing, and especially call into the question the idea that volatility to the downside should diminish at the same rate as volatility to the upside has been diminishing. Because that for sure we haven't seen. So whether or not, you want to say, nope, just because this drawdown was 2% smaller than this one, that's evidence of diminishing volatility to the downside, so therefore you're happy with that, fine. But I think it's really hard to argue, though, that the rate of diminishing volatility to the downside isn't lower than what's been going to the upside. We can see this with some other ways of depicting volatility. So want to show some charts that I just created really quickly. So this one is looking at the price deviation off of the 200-day simple moving average. So 0 is the 200-day across time, and then this is just it fluctuating around that SMA. And so what you can see is that, this first one is pretty notable. It's the highest peak and the lowest trough. We saw that pretty clearly. But you'll see that you see this very clear diminishing volatility on the upside part. See where, in the 2011 move, definitely the highest. And then it's just basically every move to the upside since has been peaking lower and lower in terms of market cycles. But then when we look at volatility to the downside, it's not as clear of a picture, right? So obviously the 2011 bottom was the most extreme deviation off the 200-day simple moving average. If we look at these other ones, the 2015 peak was lower, it did go below the 200-day simple moving average to a greater degree than these other ones. But more recently, we haven't really been seeing diminished volatility. In fact, we've already taken out the deviation below the 200-day simple moving average from 2018. We've actually went lower than that. And so that, from this perspective, clearly volatility isn't diminishing in any absolute sense because we've already taken out that low more recently in this bear market versus this bear market back here. So this is giving us a different perspective, right? This is very much showing that, yeah, absolutely, volatility is diminishing to the upside. To the downside, it's less clear that it is, or the extent that it is, it's definitely not as rapidly as it's diminishing from the upside, right? You can see that very clearly. And let's look at another way of visualizing this as well. So if you're not happy with the 200-day simple moving average as kind of a measure of kind of central tendency or kind of a central point at which the price will fluctuate, let's talk about deviation from the logarithmic best fit regression line of Bitcoin's price. So that's what I'm graphing here. So 0 again is that kind of fair value line, quote unquote, that a lot of people talk about, just kind of the best fit logarithmic regression line across Bitcoin's price history. And we can see a similar story, right? We see diminishing volatility to the upside. And we also see, but then at the same time, if we look at volatility to the downside, here we see an extremely different perspective. Here we're actually seeing the lowest volatility off of, the lowest deviation off of that best fit log regression line actually happened back in 2015. Even lower than what happened back in 2011, 2012. And then we also see, but then we do see, though, that volatility after the 2015 has been getting, relatively smaller. But then again, the bear market in 2018 was deviated from it less than the March 2020 crash. And so again, it's this less clear picture, right? I think either way that we depict these, you see the diminishing volatility across time to the upside very clearly. The downside is a little bit more murky, and it raises some questions. And the reason why I think this is important is because it could lead people astray if they don't understand this, right? I think this is a really important observation. Because I think what a lot of people think is that because volatility to the upside is decreasing at a pretty quick rate, right? A pretty rapid diminished volatility to the upside, they might assume, and I think a lot of people got caught off guard on this in this most recent bear market, there's this assumption that, oh, okay, that means that downside volatility should also have been decreasing at a really rapid rate. So therefore, seeing something like this, where we actually took out the 2018 deviation from the 200-day SMA, people might have just thought, well, that can't happen, right? If I've been told that volatility is diminishing, and that should also apply to the downside, then I might have assumed that we would just keep on setting higher lows off the 200-day SMA, and that's what it seemed like, right? Even with that move down in January, someone looking at this chart would have just said, yep, it's exactly what should happen, and that should be the bottom, right? Because it can't go lower, because that would violate our idea of diminishing volatility over time. Obviously, we didn't see that. We broke down below that. We ended up taking out that level. And then again here, we set in a lower level here than here. Again, not necessarily showing this clean diminishing of volatility to the downside. Now, overall, with a chart like this, and even with a chart like this, you'd probably argue, especially if you start back here, that the trend is, generally speaking, less volatility over time. But I just think it's important to note that that doesn't mean that we can't see stuff like this happen. And I think that's where a lot of people got caught off guard, right? I think seeing us go up and take out like this level, for example, to the upside would be extremely surprising and very unlikely. But to the downside, going out and taking out these prior levels is actually seeming a lot more plausible. So it's this idea that when we talk about diminishing volatility, we should be clear about what we mean. Really, the most clear thing we can see from the data is diminishing volatility to the upside. The downside, probably it does look, generally speaking, like it's diminishing, but it's not nearly as strong of a trend. Not nearly as strong. And it actually makes a lot of sense when you think about it, why this happens, right? One of the key arguments that people have for why we see diminishing volatility over time is because as the market cap of an asset gets bigger, it becomes harder and harder to push price up. And that just makes sense, right? When you have Bitcoin having a market cap well over $1 trillion, what we had over here, to get it to 2x off of that would take way more money than to pull an extra 2x way back here when Bitcoin's market cap was absolutely microscopic. We just know this. Anyone who's been in the crypto market knows small caps can move way faster, way quicker than large caps. It's just the way that it is. But you have to realize that as price falls for an asset, its market cap is also falling, which then, from that theory, would suggest that as price goes down, more and more volatility actually becomes more and more plausible. Because it just makes sense. The asset is becoming a smaller market cap asset. And so therefore volatility should be expected to get larger. Because again, less money then needs to move out of it to keep drawing price down. But then also less money would have to move into it to move price back up. So that's part of what's going on here. Is that kind of moves to the upside. You're really starting to hit into that issue where you need to just exponentially more and more liquidity, capital moving into the space to drive price up. But ironically, as the price falls down, you actually need less and less and less money as you go down to keep driving the price down further. And that's probably partly why we're seeing this type of behavior. Now, the final thing I want to talk about in this video then is that, this observation, that I made, one of the things that I realized was, okay, this is something that's important. And it's something I noticed before, but hadn't really thought about it as deeply as I had more recently, was, okay, this actually probably has implications for how we're calculating risk, right? So one of the things with the UDPI, our risk indicator here at the channel, was that in kind of the version that we've been running with, through this time, or kind of what was version 2, the very first version I released of the UDPI, I'd done some revisions to help it learn better from earlier data in an asset. But then what I realized was that with that model, it did indirectly learn about these volatility changes and the possibility of different volatility, the upside and the downside. But there wasn't anything explicit about the model that would tell it to pay attention to that particular factor or facet of an asset. And so basically what I've done here is I've actually just kind of tweaked the UDPI algorithm a little bit and just basically tell it, hey, upside volatility and downside volatility, pay attention to those. Those might be different. Keep an eye on those two things as it's fitting itself, as it's learning from prior price data. I've just basically built into the model to pay more attention to possible differences in upside versus downside volatility. And so this is the end result for Bitcoin. So this is the long-term UDPI, moves that play out over months. And, it looks quite similar to the previous version, right? The only thing that's a little bit different is that it's actually kind of equalized the bear market bottoms a little bit better than the previous model did. That one had these bottoms being closer to -4, and then this 2018 being the kind of absolute bottom down here. Here it's just kind of reorganized things a little bit, where we see now more or less they're kind of very close to -5, all of them in the bear market bottoms. And then, the March 2020 crash also dips down into -4. And then where we are right now also dips down into -4. But the other thing as well, with this change was that the earlier version of the UDPI did have the risk a little bit lower down here. It's actually closer to what, these levels would have been right here. But another reason why I think it's important to kind of take this into account in a risk model is that it's actually, now that I've told it to pay more attention to possible differences in upside versus downside volatility, it's slightly revised its risk estimate. Now, not anything that's too meaningful, right? We're still down below -4, still in the lowest kind of risk level. It's just that it's not as convinced now that we were at kind of this bottoming point that we've seen in the past as the model that wasn't directly paying attention to these possible differences in upside versus downside volatility. So that's one of the reasons why I personally, like this version of the UDPI, this tweak to it, is that I think it just better represents the dynamics of the assets, that they tend to behave this way. that volatility to the upside is not the same as volatility to the downside. So you should let the model, more explicitly learn that distinction. It was indirectly learning that before. I've just made it a more explicit part of the model here. And personally, I think it just makes for a better model. Now, overall, the interpretation hasn't really changed all that much, but I did just want to mention it because this is just one little tweak, something that I think is just a useful addition to the model. All right, if you like the content, remember to subscribe to the channel, give the video a like and follow us on Twitter. Put a lot of updates, better indicators, and more over there.